Have you ever considered that just a single letter in a software menu, or maybe the capitalization of a specific word on a balance sheet, could literally be the difference between a clean audit and a complete regulatory nightmare?
I mean, when you put it like that, it sounds extreme, but yeah, it absolutely can be.
Right, because if you are sitting there looking at your own small business ledger right now, or maybe you're preparing to launch a new company, you probably think of accounting purely as math.
Or exactly. You worry about the revenue, the expenses, the bottom line. That's what people care about.
Yeah, but there is this whole invisible architecture holding all of that math together, and that structure, which dictates whether you are actually complying with the law or, inadvertently committing tax fraud, is entirely based on language.
Language, syntax, and
Right.
localized design. Yeah, it is foundational.
Okay, let's unpack this. Because today we are doing a deep dive into the newly updated 2026 chart of accounts, templates, and language files for the accounting software osFinancials and TurboCASH H.
And we are going to unpack how hyper-specific, localization-like, everything from the historical reasons behind Canadian spelling to the absolute multi-jurisdictional chaos of U.S. tax logic shapes your user experience and honestly protects you from the government.
And before we get too far in, I do want to briefly mention that there are some really extensive discussions on this exact topic over on YouTube.
Yeah, if you want to actually see the code and the visual interfaces we're dissecting, there's a great video resource called USA and Canada, The Hidden Rules of Language.
And there's also a companion audio piece just called The Hidden Linguistics. They both go exhaustively into these 2026 updates. So if you want to see the literal software strings we're talking about today, definitely check those out.
But to really grasp why those strings matter, we have to look at the philosophy of language in a digital environment. Because language really creates the entire user experience.
I want to start right there, actually, with the linguistics. Because, if I am downloading accounting software, my immediate concern is whether it can calculate my taxes.
Right. You just want it to work.
Exactly. I am definitely not thinking about whether it uses Noah Webster's American Spelling Dictionary or some British-influenced Canadian dictionary.
Well, and that's the thing. The developers of these 2026 templates, they spent an agonizing amount of time auditing the language files for exactly this reason.
And to understand why, we have to kind of look at the history of how these two dialects diverged, right?
Yeah, so Noah Webster intentionally set out to essentially simplify American English after the Revolutionary War.
He wanted a distinct American language to separate the new country from Britain.
Exactly. So he just dropped the U from words like color and honor. He flipped the R and the E in words like center.
And meanwhile, Canada retained all those British spellings to signal their ongoing loyalty to the crown. But then, because they share this massive, totally porous border with the U.S., they absorbed Americanisms over time.
Right, which created this highly specific hybrid linguistic environment in Canada that is just an absolute minefield for software developers.
Wait, why is it a minefield, though? It's just spelling.
Well, it's a minefield because databases do not understand context.
Yeah.
They don't understand nuance. They only understand exact string matches.
Oh, right, because users don't click through 20 nested folders anymore?
Exactly. They use a search bar, they hit a hotkey, and just start typing.
So if a Canadian user is in their UI settings trying to find the checkbox to use colors for out-of-stock items, they are naturally going to type COLOUR.
And if the developer hasn't localized the database, and the software only recognizes the American COLOR, the search just returns a blank screen.
Wow. So the software effectively tells the user that the feature doesn't even exist.
Exactly. It gaslights them. It makes the user feel like they don't know how to use the tool, or worse, that the tool itself is broken.
It completely shatters user trust.
It really does. If the interface feels foreign, the user immediately begins to doubt the underlying math.
I would. If I log in and see typos, I'm going to wonder if the calculator's broken too.
Yeah. So if a Canadian contractor logs into a payroll module and sees a prompt for labor instead of labor, or an invoice status that says canceled with one L instead of the Canadian double L, they experience these little micro frictions.
Right. A single instance might just look like a typo.
But when you are processing, say, 300 invoices a week, those micro frictions compound into severe cognitive fatigue. The user is constantly translating the software's dialect into their own mental dialect before they can even process the actual financial data.
Okay, let's look at a scenario where that translation actually causes a real financial error rather than just annoyance. Because the re versus error rule mostly applies to words of French origin, right?
Okay, so in the U.S., you have center, C-E-N-T-E-R, In Canada, it's centre, C-E-N-T-R-E.
But the stakes get incredibly high when we talk about units of measure. The templates had to meticulously divide the concept of a meter from a meter.
Well, this is a great example. In the United States, METER does double duty. It is the unit of distance, 3.28 feet, and it is also the word for a physical measuring device.
Like a water meter or a parking meter.
Right. But in Canada, those are two entirely distinct concepts with distinct spellings. METER is exclusively the physical diagnostic tool. The unit of distance, like the stock measurement, is METRE.
So put yourself in the shoes of a procurement manager for a Canadian commercial construction company.
Okay.
You are setting up your inventory management system in the software. You're inputting thousands of linear feet of copper piping, industrial cabling, conduit, whatever. If the software asks you to input the wholesale cost per meter, ending in EOR, you have to literally stop and decipher the intent of the program.
Exactly. Are you supposed to be entering the cost of the actual physical diagnostic tools you are installing in the utility closets? Or is the software asking for the linear cost of the copper pipe itself?
And when you introduce ambiguity into inventory stock management, you introduce financial loss.
Massive financial loss. If that procurement manager enters the $5,000 cost of a diagnostic tool into a field that the software is actually using to calculate the per unit cost of copper piping, every single project estimate they generate from that database forward will be wildly inflated.
They will lose bids, they'll fail to secure contracts.
All because the software failed to distinguish between a device and a distance. It's crazy.
And there are other subtle traps in these language files, too. Take the eyes versus I suffix.
Oh yeah, this one is fascinating.
Right, because it breaks the expected pattern. If Canada generally follows British rules, you would expect them to use the S for everything. Like, the British spell it O-R-G-A-N-I-S-E.
They do. But the Canadian templates actually align with the US here. They use the Z, organize, customize, maximize.
But wait, there's an exception, isn't there?
There is a massive hard-coded exception in the reporting modules, the word analyze. In the US, it is universally spelled with a Z. But in Canadian financial reporting, specifically when generating documents like an agent analysis for accounts receivable, it retains the S.
Wow. So the developers had to map hundreds of individual string IDs, like ID 3300 for colors or ID 3536 for canceled remittances, just to ensure that the interface feels completely native to the region operating it.
Yeah, it's incredibly tedious work, but it's essential.
Okay, but spelling differences are still just words on a screen. Where the 2026 templates start to push into the actual philosophy of user experience is with prepositions.
Yes.
Because the developers completely audited and purged the use of the word per in favor of the word by across almost the entire user interface.
What's fascinating here is that this represents a massive evolution in how we interact with databases.
How so?
Well, to understand the shift, you have to look at the architecture of legacy systems. Older accounting software, particularly systems built in Europe or built on 1990s SQL database architecture, relied heavily on literalism.
Okay, meaning what?
Meaning, the menus were essentially direct translations of the database queries running in the background. So if the software needed to execute a grouping command to show you revenue tied to specific buyers, the literal mathematical translation of that command was sales per customer, or, graph customers per month.
So using per in modern software is basically like wearing a tuxedo to a beach party.
That is a perfect analogy.
Yeah.
Yes, technically it functions as clothing, it covers you up, but the context is entirely wrong for the environment.
Everyone knows you don't belong, and it creates this strange, rigid atmosphere.
Yeah.
Because per feels mathematical. It feels like a division problem.
It does. It creates totally unnecessary cognitive friction. In a 2026 North American business environment, BY is the undisputed intuitive standard for sorting, filtering, and grouping data.
Right, like search by name or show me sales by salesperson. It feels like a natural conversational request.
You are asking the software to perform an action on your behalf. Show me sales per salesperson. Feels like you're reading a textbook. So the 2026 updates went through and systematically changed these commands. The software now actually speaks the user's natural language.
But wait, if by is the new standard, does per just get deleted from the software entirely, or does it still have a mathematical function?
It is strictly quarantined. The developers drew a hard line. Per is now reserved exclusively for actual literal ratios and units of measure.
Like what?
Like you will see lines per inch in the printing configuration, Or you will see it in formal, legally mandated reconciliation citations, like as per bank statement.
Okay, that makes sense.
But it has been entirely removed from the navigational hierarchy. When the interface speaks conversationally, the user just spends way less mental energy translating the software's intent. They can look at the screen and immediately understand how to manipulate their data.
That concept of mental energy, what developers call cognitive load, is actually the perfect bridge into how the ledger is visually presented. Because if natural phrasing builds subconscious trust, typography builds the visual map that allows an accountant to do their job without suffering a migraine.
Absolutely. The language updates directly dictated how the new chart of accounts is capitalized.
To appreciate this modernization step, you really have to remember what early accounting software actually looked like.
Oh boy. Think back to the DOS era, or early Windows systems. We are talking about 80-character monochrome green screens.
Memory limitations and display limitations meant that typographical hierarchy basically didn't exist. Everything was rendered in all cap S.
Yeah, I have stared at those legacy flat file exports. It is literally a wall of text screaming at you, bank cash, accounts receivable, office supplies.
Every single line carries the exact same visual weight. Exactly. If you are a financial controller staring at a massive trial balance for 8 hours a day, the physical toll on your eyes is immense. Your brain cannot naturally group the information, so your eyes have to manually scan and read every single character to figure out where one category ends and another begins.
Physiologically, it induces what we call saccadic fatigue.
Saccadic fatigue.
Yeah, the human eye relies on the ascenders and descenders of lowercase letters. The tall lines of a T or an L, the dropping tails of a P or a Y to quickly recognize word shapes. When everything is in alt-ag PS, every word is just a rectangular block.
You completely lose the ability to skim.
Exactly. You can't skim rectangular blocks. The 2026 templates solve this by introducing a strict, universally applied typographical hierarchy. It's a brilliant anti-fatigue measure.
Okay, let's walk through the actual rule they implemented. How does the software decide what gets capitalized?
It is based entirely on the structural level of the account. Main accounts, these are your parent accounts, the level 1 groups that act as overarching roll-up headers, must be entirely uppercase.
So your primary asset bucket will read current assets in all caps.
Yes, but the sub-accounts beneath them, the actual granular transactional accounts where the money is recorded, must be in sentence case.
Meaning only the very first letter of the first word is capitalized.
Correct. So underneath current assets, you will see accounts receivable with a capital A and a lowercase r.
But there has to be an exception for legal acronyms, right? Because if I am a Canadian business, I can't just lowercase the GST.
You're right. There is an exception. Even within a sentence case subaccount, an official, legally recognized acronym must remain fully capitalized to comply with reporting standards.
So it is always GST, HST payable.
It can never be GST, HST payable with lowercase letters. Lowercasing a legal tax acronym would technically invalidate the formal presentation of the liability.
Okay, I totally understand the anti-fatigue aspect for the person doing the data entry, but why is this typographical rule so vital for the actual generation of Canadian financial statements?
You mean for external reporting?
Yeah, because the source materials specifically called out ASPE, the accounting standards for private enterprises, and IFRS, the International Financial Reporting Standards. Why do those massive governing bodies care about upper and lowercase letters?
It's because of how financial statements are consumed by external stakeholders. When a CPA or a controller pulls up a trial balance to prepare year-end statements, they need to instantly, subconsciously differentiate between a roll-up header and a transactional detail.
Right.
In the old systems, the only way to know the difference was to actually memorize the numeric account codes. You had to know that a 1000 code was a header and a 1010 code was a detail.
Which is an absurd expectation when you have thousands of accounts.
It's completely absurd. The modern typographical hierarchy builds a visual scaffold. The uppercase headers just jump off the page. It creates natural breaks in the data.
Oh, I see.
And when you generate a formal balance sheet to hand over to a bank for a loan application or to an investor, you typically only show those main uppercase accounts. The granular sentence case transactional accounts are collapsed and stay in the background for internal auditing.
So by hard-coding this typographical rule, the software ensures that the external reports are incredibly clean, professional, and compliant by default.
Yes. The business owner doesn't have to spend hours formatting an Excel export to make it look presentable.
Okay, so we've covered the words, the regional spelling, the conversational phrasing, and the visual hierarchy. Now we have to look at the actual architecture holding all of those words together.
The underlying numbering system.
Exactly. Because the 2026 USA Chart of Accounts templates completely overhauled the numbering system. This is where the software transitions from being just a user-friendly tool to being an absolute compliance engine.
Oh, without a doubt.
They have completely abandoned the unstructured legacy format and fully embraced US GAAP compliance.
GAAP, or Generally Accepted Accounting Principles, is the bedrock of American corporate finance. The old flat legacy charts in osFinancials and TurboCASH have literally been marked for deletion.
Wait, they're just completely gone.
They are obsolete. And they are obsolete because a flat structure inevitably collapses under the weight of a growing business.
Let's visualize how bad a flat structure really is. I picture it like the junk drawer in a kitchen.
That's a great way to put it.
You start a business and you have a general block of numbers for expenses, say the 60,000 range. Every time you incur a new type of expense, maybe a new software subscription or a hyper-specific type of office supply or a completely new marketing channel, you just toss it into the junk drawer.
You just assign an account 6001, then 6002, then 6003.
Right. You have no folders, you have no categorization. Everything is just listed chronologically based on when you created the account.
And 5 years later, that junk drawer is completely jammed. You have hit account number 69,999. You have completely exhausted the numbering block.
So what does a business actually do when they run out of numbers in a flat database?
Well, they panic, mostly. And then they start spilling their general expenses over into the 70,000 range or the 80,000 range.
Oh, no.
And the moment they do that, they destroy the standardized numbering schema. When an American auditor or a CPA comes in and sees basic operating expenses sitting in the 80,000 block, which is universally reserved for other income or extraordinary items, the auditor immediately knows the books are a mess.
I imagine that triggers an exponentially longer and more expensive audit process.
It absolutely does. The 2026 templates solve the junk drawer problem by introducing a highly scalable 8-digit system. It is composed of a 5-digit main account followed by a 3-digit sub-account.
So instead of tossing everything into one drawer, you are now working with a finely tuned filing cabinet.
Yes, the 5-digit code is the heavy metal drawer representing the major category. The 3-digit code is the expandable green folder inside that drawer, representing the specific transactional account.
And this architecture introduces a critical database concept called account compression, because you can now nest up to 999 sub-accounts inside a single 5-digit main account. You drastically compress the footprint of your primary ledger.
Right, you are never going to run out of room for office supplies because you have 999 slots just inside the office supplies drawer.
And because of this massive compression, the developers were able to do something incredibly forward-thinking with the US templates. They left the entire 70,000 range completely blank.
Yeah, they created a strategic buffer. By keeping the 70,000 block empty, the template anticipates future growth.
So if a mid-sized company acquires a competitor 10 years down the line or launches an entirely new manufacturing division,
they don't have to shoehorn those new operations into their existing expense blocks. They have an entire pristine 10,000 account buffer ready to absorb the new corporate structure without breaking GAAP compliance.
Speaking of GAAP, let's talk about the FASB, the Financial Accounting Standards Board. These are the people who actually write the rules for US GAAP. How does this new 8-digit structure actively enforce their mandates?
The FASB dictates that any business of a certain size, or any business reporting to outside investors or banks, must use accrual basis accounting rather than simple cash basis accounting.
Okay, just as a refresher, accrual means you record revenue when it is earned, not when the cash hits your bank. And you record expenses when they are incurred, not when you actually pay the bill.
Exactly. And the 2026 Chart of Accounts hard-codes the architecture required for accrual. It mandates dedicated, undeletable accounts for customer control, which we commonly call accounts receivable, and supplier control for accounts payable.
And it also pre-builds the specific, highly complex tax accounts required by the IRS.
Yes, specifically the payroll tax liabilities.
You mean things like FUTA and SUTA.
Right. FUTA is the Federal Unemployment Tax Act, and SUTA is the State Unemployment Tax Act. In a legacy system, a business owner might just create one account called payroll taxes and dump everything in there.
Which is a huge no-no.
Under GAAP and under IRS scrutiny, that is totally unacceptable. The employer portion of these taxes must be tracked independently from the employee withholding portions, and federal liabilities must be structurally isolated from state liabilities. The 8-digit template builds these separate folders by default.
This is where localization shifts from just being, helpful to actively providing legal protection. The source documents detailed the localization for the California LLC US GAAP template.
Yes.
And this blew my mind because it highlights how specific corporate dialect actually is. If you run an LLC in California and you use the term shares or common stock on your equity accounts, you're waving a massive red flag at the government.
It is a profound error in legal vocabulary that immediately reveals a lack of competence to an auditor.
Because an LLC, a limited liability company, is a specific legal entity designed to protect the owners from personal liability, but it does not operate like a C corporation.
Exactly. An LLC does not issue stock. It issues member interest, which is legally quantified as units.
So if an auditor from the California Franchise Tax Board, the FTB, who are notoriously aggressive when it comes to state corporate taxes, if they pull your balance sheet and see an equity account labeled common stock, what goes through their mind?
They immediately assume that whoever set up these books does not understand the corporate entity structure they are operating under.
Right.
If you don't know the difference between a unit and a share, the auditor logically assumes you also don't understand the rules for owner distributions or the specific California gross receipts tax brackets. It just invites intense scrutiny.
Wow. So the 2026 California LLC template automatically enforces the term units for the equity accounts. It prevents the business owner from making a foundational vocabulary error that could trigger a full-blown audit.
It does. The templates also enforce strict GAAP rules regarding offsetting, specifically with interest.
Okay, wait. Why does GAAP care if I net my interest? If my business checking account earns $100 in interest this month, but I paid $500 in interest on my small business loan, why can't I just create one account called net interest and report a $400 expense? The math works out the exact same on the bottom line.
The bottom line might be the same, sure, but the transparency is completely destroyed. GAAP strictly prohibits netting revenues against expenses because it obscures leverage.
Obscures leverage, meaning what?
If a bank is looking at your financials to decide if they should give you another loan, they need to know exactly how much gross interest you are generating and exactly how much debt burden you are carrying. If you net them together, you hide the true scale of your liabilities.
I see. So if I earned $1 million in interest, but paid $1,001 in loan interest, my net interest is only -$1.
Exactly. It looks like nothing.
But in reality, I am carrying a massive, incredibly risky debt load.
Precisely. You are obscuring the true risk profile of the business. The 2026 templates enforce this transparency structurally. They place interest earned in the $80,000 range, which is categorized as other income.
And they place interest paid somewhere else entirely.
Right, in the completely separate $85,000 range, categorized as other expenses. Because they're in different 5-digit master blocks, the software literally will not allow you to combine them into a single line item on the income statement. You must show the total gross earned and the total gross paid.
So what does this all mean for the actual user? I have to push back here a bit, though. Put yourself in the shoes of a small business owner.
Okay.
You just want to sell roasted coffee beans or fix plumbing. You download the software, and suddenly you are confronted with an 8-digit alphanumeric system, strict rules against netting, and hyper-specific legal vocabulary mandated by the California FTB.
It's a lot.
It's overwhelming. Does this complexity actually make it easier for the business owner? Or are developers just building software that caters exclusively to CPAs, leaving the actual entrepreneur completely lost?
It is a totally valid concern. When you first look at an 8-digit ledger, it looks deeply intimidating. But here is the reality of modern business. The complexity of the software protects the simplicity of the business.
Okay, unpack that.
By pre-configuring these templates, by making sure the LLC is already using the word units, by ensuring the interest accounts are already split into the 80,000 and 85,000 blocks, the software removes the burden of architectural compliance from the owner's shoulders.
So you don't need to be an expert in GAAP because the software is already an expert in GAAP. You just have to follow the prompts.
Exactly. You just put your receipts into the pre-labeled folders in the filing cabinet. It massively reduces the anxiety of an audit. And crucially, it drastically reduces your accounting bills.
Oh, because of the billable hours.
Right. When you hand a flat, unstructured, disorganized database over to a CPA at year-end, they have to spend 10 or 15 billable hours just untangling the mess and mapping it to a GAAP-compliant structure before they can even file your taxes. With the 2026 templates, that structure is already perfect.
Okay, having that perfectly structured filing cabinet is going to be absolutely essential when we transition into the actual mechanics of multi-jurisdictional taxation.
Oh, absolutely.
Because the U.S. tax system is arguably the most chaotic, fragmented, and aggressive accounting environment on the planet.
It is entirely unique among developed economies. If you look at Europe or Canada, they rely on a federal value-added tax, or VAT. The rules are generally standardized at a national level.
But the United States does not have a federal sales tax.
No, instead, the power to tax transactions is delegated down to thousands upon thousands of overlapping hyperlocal districts at the state, county, city, and even neighborhood levels.
The sources gave a harrowing example of sales tax stacking. It is not uncommon for a single retail transaction in a state like New York or Texas to trigger 3 or 4 simultaneous tax liabilities.
Let's break down a specific scenario in Austin, Texas, because it perfectly illustrates the manual pain point the software is trying to solve.
Okay, let's hear it.
The state of Texas levies a base sales tax rate of 6.25%. But the municipality of Austin needs to fund its own city services, so it adds a 1% city tax on top of that.
Right.
And maybe the local transit authority, the MTA, adds another 0.5% to fund the bus system. So the consumer walking into a store pays a combined stacked rate of 7.75% at the register.
In a legacy accounting system, a business owner would look at that and say, well, the customer pays 7.75%. I will just create a single liability account called Texas Sales Tax 7.75% and dump all the collected money in there. Why is that a catastrophic idea?
Because the state of Texas does not get to keep all that money, and you do not just write one giant check to the ether. The Texas comptroller acts as a clearinghouse.
Okay.
They demand to know exactly how much of that remitted money belongs to the state general fund, how much needs to be wired back to the city of Austin, and how much belongs to the transit authority. If you have lumped all of those fractions into a single bucket, you are faced with a mathematical nightmare at the end of the month. You have to export your sales data and manually reverse engineer every single transaction to figure out the exact fraction of a cent owed to each entity.
And if you make a mistake on a spreadsheet at midnight, you shortchange a municipality and they will absolutely audit you to get their fraction of a cent back.
They will.
So how do the 2026 osFinancials and TurboCASH H templates actually solve the stacking problem?
They attack it with two specific architectural mechanisms. The first is structural. The chart of accounts introduces a dedicated buffer zone in the G23100 series, which is the section of the ledger reserved for sales tax payable. They deliberately engineered a numeric gap between the main control account and the final clearing accounts.
Explain how a numeric gap helps. Is it like leaving blank lines on a government form so the user can just write in their specific city code?
Exactly. But it is integrated directly into the database hierarchy. It gives the end user the structural space to insert their hyper-specific local tax liabilities, their specific state, county, and city percentages, without breaking the logical 8-digit flow of the surrounding ledger.
Okay, and the second mechanism?
The second is computational, and it is called the link tax configuration.
This is where the automation really kicks in, right?
Right. Sophisticated businesses use link tax to automate the jurisdictional breakdown at the exact moment of the sale. You configure the software to link the primary state tax code to the secondary city tax code and the tertiary transit tax code.
So when the cashier rings up a $100 item and selects the generic Austin sales tax profile,
The software's engine fires off 3 simultaneous calculations. It sends $6.25 directly into the state liability folder, $1 into the city liability folder, and 50 cents into the transit liability folder.
it perfectly slices the pie before the money even hits the balance sheet.
And it does so invisibly. The user just sees the final 7.75% on the receipt, but the database is perfectly segregated for the end-of-month remittance. But if we connect this to the bigger picture, the most expert-level application of this link tax technology in the U.S. is how it handles the self-assessing use tax.
Oh, use tax. This is one of those concepts that terrifies small business owners because it relies almost entirely on an honesty system that states are increasingly trying to enforce. For anyone who isn't familiar, what is use tax?
Historically, it was known as the Amazon loophole.
Okay.
If you are a business in California and you buy a $10,000 server rack from a vendor in Oregon, which has no state sales tax, the Oregon vendor does not charge you tax on the invoice. You saved 8%.
Sounds like a great deal.
But California tax law dictates that because you are using that server rack within the borders of California, utilizing their infrastructure and emergency services to protect your business, you still owe the state that 8% tax. You are legally required to self-assess the value of the purchase and declare the liability on your tax return.
Which, let's be honest, historically nobody ever did.
Nobody did it. But now states are aggressively auditing out-of-state vendor invoices to claw back that lost revenue. If you forget to self-assess the use tax on a massive equipment purchase, the penalties are severe.
So how does the link tax automate the honesty system?
By tying the tax trigger directly to the expense category, a business can configure the software to link a use tax code directly to their office equipment or IT hardware expense accounts.
So when the bookkeeper enters the Oregon vendor's bill for the $10,000 server rack, which shows zero tax on the paper invoice, what happens?
The software recognizes the expense account, fires the link tax engine, and automatically generates a secondary invisible accrual entry. It adds the $800 use tax liability directly to the state tax payable bucket and simultaneously capitalizes that $800 into the cost of the server rack.
That is brilliant. It completely removes human memory from the compliance equation. You enter the bill exactly as it looks on paper, and the software handles the legal obligation in the background.
Exactly. It's seamless.
Well, if the U.S. system is a chaotic, fragmented stack of local jurisdictions desperately trying to capture revenue, the Canadian system is a masterclass in hybrid tax mechanics. Let's look at how the software crosses the northern border. Because Canada fundamentally relies on a value-added tax, but they have two completely distinct models running simultaneously depending on the geographic borders of the province you are standing in.
This is where the localization files really earn their keep, because they have to swap the underlying logic of the database based on the user's region. The Canadian system is divided into the harmonized tax system, which is a beautifully streamlined single tax model, and a dual tax system, which utilizes that exact same link tax architecture we just discussed, but for entirely different, deeply complex reasons.
Okay, let's start with the streamlined one, the harmonized sales tax, the HST. This applies to provinces like Ontario, where the rate is 13%, Nova Scotia, which is jumping to 14% in 2025, and New Brunswick, Newfoundland, and Prince Edward Island, which are 15%. What does harmonized actually mean for the business owner?
It means the federal government and the provincial government have agreed to stop fighting over the administrative paperwork. They merged their separate taxes into a single rate. As a business owner in Ontario, your life is relatively simple.
Because you only deal with one agency.
Right, you deal with exactly one agency, the Canada Revenue Agency, or the CRA. You file one single tax return. You charge one unified 13% tax rate to your customers.
And behind the scenes, the CRA collects the massive pool of money and handles the incredibly complex math of splitting it with the provincial government.
Exactly. So from the software's perspective, this requires no linked tax setup at all. You just have a single, straightforward tax account that processes the full combined percentage.
But the moment you move your business west or into Quebec, that simplicity vanishes. You enter the dual tax provinces, Quebec, British Columbia, Saskatchewan, and Manitoba.
In these specific provinces, the provincial governments refused to hand over their taxation authority to the federal CRA. They wanted to maintain control over their own revenue streams. So businesses must track two entirely separate taxes simultaneously on every single transaction.
You have the federal GST, the goods and services tax, which is a flat 5% across the entire country, and then you have a secondary provincial tax stacked on top of it.
Yes, in BC, Saskatchewan, and Manitoba, it is the PST, the provincial sales tax. In Quebec, it is the QST, the Quebec sales tax.
This is where the software has to deploy the link tax mechanism to hitch them together. I visualize this like a freight train.
A freight train.
Yeah, like the federal 5% GST is the locomotive. It is the primary engine pulling the transaction forward. And the PST or QST is the secondary cargo car that the software automatically hitches to the back. When the user selects the primary GST code on an invoice, the software's algorithm knows to automatically calculate the provincial tax and drag it along, applying both percentages to the same subtotal.
That is an excellent visualization of the calculation mechanic. But the critical technical challenge for the database, the reason these taxes must be processed through separate accounts, comes down to a foundational concept in Canadian tax law: recoverability.
Wait, if I am paying tax on the goods I buy to run my business, shouldn't I be fighting to get all of that tax back? Unpack recoverability for me, because it sounds like the government decides which taxes are actually real costs and which ones are just temporary loans.
That is essentially how a value-added tax functions. The federal GST, the harmonized HST, and the Quebec QST are all value-added taxes. The foundational philosophy of a VAT is that the tax should only be paid by the final end consumer. Businesses in the supply chain are not supposed to bear the burden of the tax.
So if your business buys a $2,000 computer to run your dispatch software, you pay the 5% GST, which is $100 to the vendor.
Right. But because you are a registered business, that $100 is recoverable. You file a claim with the government called an input tax credit, and they refund you the $100.
So in the accounting software, that $100 doesn't go into my computer expense account. It goes into a tax receivable asset bucket on my balance sheet because it is essentially a guaranteed IOU from the government.
Precisely. It sits as an asset until you reconcile your return. But the provincial sales tax, the PST in British Columbia, Saskatchewan, and Manitoba, is completely different. It is a retail sales tax.
What's the difference?
The philosophy here is that the tax is applied to the final consumption of the good, regardless of who is consuming it. For the vast majority of businesses, PST is legally non-recoverable. You do not get an input tax credit. You do not get a refund. It is a hard sunk cost of doing business.
Okay, this is where the logic of the software becomes critical. If the PST is a sunk cost and I am not legally allowed to get it back, how does the software know not to put that money into my tax receivable bucket?
It has to be configured perfectly.
Because if the software defaults to treating all tax the same way and dumps my PST into that asset bucket, I'm going to blindly file my return, claim a refund I am not entitled to, and the CRA is going to drop the hammer on me.
You would be committing tax fraud by sheer ignorance. This is why the precise configuration of the link tax is a matter of corporate survival. When the localization template is deployed for British Columbia, it configures the primary 5% GST account as recoverable, explicitly routing the mathematical output to the asset bucket on the balance sheet.
Okay.
But it configures the secondary 7% PST link as non-recoverable.
What does the non-recoverable command actually do to the data?
It forces the software to capitalize the tax directly into the original expense. Let's say you buy $100 worth of printer paper. The software calculates $5 for the GST and sends it to the receivable bucket to be refunded.
Okay. Making sense so far.
It calculates $7 for the PST, but because of the non-recoverable flag, it buries that $7 directly into your office supplies expense account. Your final ledger shows an office supplies expense of $107 and a tax receivable asset of $5.
It automatically absorbs the unrecoverable tax into the cost of the goods. That is incredible. It completely removes the risk of the user claiming fraudulent input tax credits because the PST literally never touches the tax reporting modules. It just becomes part of the expense.
Exactly. But it requires the underlying chart of accounts to be perfectly, flawlessly mapped to the regional tax codes. If the accounts are misaligned, the automation completely breaks.
Which brings us to perhaps the most complex automation challenge in the entire North American accounting landscape.
I think I know where you're going with this.
Yeah, if we are talking about asking the government for money back, we have to talk about the 50% meals and entertainment rule and the highly specific, incredibly punitive audit environment of Quebec.
If you operate a business in Canada, you must understand the 50% rule. It is a strict, unyielding directive from both the CRA federally and Revenue Quebec provincially.
The logic seems pretty straightforward, right?
The logic is simple. If you take a prospective client out for a $100 dinner to discuss a contract, the government acknowledges that you are trying to generate revenue. But they also argue that, human biology being what it is, you had to eat dinner anyway.
Right, you received a personal benefit.
Therefore, the government dictates that only half of that $100 dinner is a legitimate, deductible business expense. The other $50 is considered personal consumption, and you cannot write it off against your corporate income.
That makes logical sense, but how does that actually impact the tax recoverability we just talked about?
It creates a proportional cascade. If only half of the core expense is legally deductible, then only half of the value-added tax paid on that expense is recoverable. You only get half of your input tax credit.
I want to walk through the exact mathematical scenario outlined in the source documents for a business lunch in Montreal, Quebec, because it perfectly illustrates the manual pain of this law. Let's assume you take a client to lunch, and the base expense for the food is exactly $100.
Okay. On top of that $100 base, the restaurant charges you the federal 5% GST, which is $5. They also charge you the provincial 9.975% QST, which will round to $9.98.
Okay, so the total bill you pay with your corporate credit card is $114.98.
Right. So if I am a junior bookkeeper working late on a Friday night and I don't have this 2026 software perfectly configured, I look at the receipt and I just enter 114.98 into the system. The software, using standard logic, puts $100 into my meals expense account. It puts $5 into my GST receivable bucket to get a refund, and it puts 9.98 into my QST receivable bucket to get a refund.
And then I file the return, I claim all 14.98 back.
And you have just blatantly violated provincial and federal tax law. You overclaimed your expenses and you overclaimed your tax credits.
Wow.
If Revenue Quebec audits that specific meal, they will claw back the taxes, disallow the expense, and levy interest and penalties on the infraction.
So what does the bookkeeper actually have to do manually to comply if they don't have the automation?
Oh, they have to perform a six-way mathematical split on every single restaurant receipt.
A six-way split. Walk me through it.
First, they split the $100 base expense. $50 goes to the legally deductible meals account, and $50 must be coded to a separate non-deductible equity or draw account.
Okay, that's two splits.
Second, they split the $5 GST. $2.50 goes to your recoverable asset bucket to be claimed on the return, and the other $2.50 must be capitalized into the non-deductible expense account.
Okay, four splits.
Third, they split the 9.98 QST half, or $4.99, is routed to the recoverable QST bucket, and the remaining 4.98 is capitalized into the non-deductible expense account.
Doing that manual calculation with fractions of pennies for every single coffee, lunch, and dinner receipt a mid-sized sales team generates in a month. That would take dozens of hours. The margin for human error on a calculator at midnight is practically 100%.
It is an absolute nightmare for a human to process manually, but it is a trivial calculation for a localized database.
How does the software handle it?
The 2026 Canadian Localization solves this by utilizing a specific non-deductible tax account configuration within the software engine. The user simply types the gross amount, 114.98, into the entry screen and selects the pre-configured meal's 50% Quebec tax code from the drop-down menu.
And just does it.
The software executes that complex six-way mathematical split instantly, routing the exact pennies to the correct deductible, non-deductible, and recoverable ledgers in the background.
That is the profound magic of localization. It translates the raw punitive text of tax law into a single drop-down menu click. Now, you mentioned QST and Revenue Quebec. The province of Quebec has another massive administrative quirk that requires a highly specific architectural structure in the chart of accounts.
This raises an important question, yes.
Because in every other province in Canada, even if you are tracking a dual tax like the GST and the PST in British Columbia, who does the business actually register with?
You register with the federal government. The CRA is your primary point of contact for the VAT system.
But in Quebec, the province fiercely protects its autonomy, and it acts as its own primary agent.
Yes. Quebec's unique agency split means that once your business crosses the $30,000 annual revenue threshold, you are legally required to register with Revenue Quebec for both the provincial QST and the federal GST.
Wait, really? Both?
Yes, Revenue Quebec essentially administers and collects the federal tax on behalf of the CRA within the borders of the province. You file your returns directly with the province, and they handle the federal remittance.
And this creates a major technical paradox in the software architecture, which the source documentation refers to as the engine versus the vault. This is one of the most critical database concepts we're going to cover today. Walk us through exactly what the engine and the vault are.
In the 2026 Quebec Chart of Accounts, if you open the ledger, you will notice a strict, unbreachable separation between account G2310900 and account T2310905.
Okay, so a G account and a T account.
Right. The vault is the general ledger account. It is prefixed with a G. You can visualize this as the physical bucket sitting on your balance sheet. It is a static, passive container. Its only job is to hold the final mathematical result, showing you exactly how much money you owe the government at any given moment.
And the engine.
The engine is the tax link account. It is prefixed with a T. This is not a bucket. It is an active algorithmic calculator. Only job is to generate the math during the split second of data entry.
So why this strict separation? I mean, if I am a developer trying to write efficient code, why wouldn't I just give the vault the ability to do its own math? Why can't the bucket also be the calculator? It seems redundant to have two separate accounts for the exact same tax.
It seems redundant until you understand how database variables actually interact. If a vault is used as its own engine, If the codes are mapped over each other so that the bucket is also the calculator, it creates catastrophic recursive loop in the software's code.
A recursive loop. Break down how that loop actually happens in practice.
Let's say you enter a $1 transaction. The vault, acting as the engine, sees the $1 and applies the 5% tax algorithm. It generates 5 cents. It drops that 5 cents into itself, the vault. The balance is now $1.05.
Okay, simple enough.
But because the vault is also the engine, it immediately detects new activity. It sees that it just received 5 cents. The algorithm triggers again, applying a 5% tax to the 5 cents. It generates a fraction of a penny and drops it into the vault.
Oh, no.
The vault detects new activity, and the algorithm fires again. It loops infinitely.
A Stack Overflow. The software either crashes or it artificially balloons your tax liability into infinity.
Exactly. Or, on a less dramatic scale, it fails to clear the tax when you actually make a payment. If you write a check to Revenue Quebec to empty the vault, the engine might view that payment as a negative transaction and try to calculate a tax refund on the payment itself.
It absolutely ruins the integrity of the financial statements.
It does. The 2026 updates ensure that T2310905, the engine calculating the QST, lives on an entirely separate, isolated plane from G2310900, the liability vault holding the QST. The engine observes the transaction, calculates the math, throws the money over the wall into the vault, and then shuts down completely.
It is like trying to use a tape measure as a storage box. It is fundamentally the wrong tool for the job, and if you force it, you break the tool and ruin the materials. The separation of powers within the database architecture is the only thing that guarantees data integrity.
And that data integrity is what keeps a business solvent. If your database loops and overstates your liabilities, you pay money to the government that you desperately need for payroll.
Man, we have unpacked a staggering amount of architecture today. I want to just kind of pull back and synthesize this journey because we started with what seemed like a totally trivial spelling lesson. Why Noah Webster dropped the U in color, why Canadian UI uses a Z in organize but an S in analyze. And we moved through typographic choices like capitalizing current assets to stop accountants from going blind.
Right.
But what this really revealed is an intricate, invisible web of logic.
It really highlights the central truth of modern accounting software. Localization is not translation.
No, not at all.
Translating a menu from English to Spanish is a basic linguistic function. Localization is the process of translating complex local law, multi-jurisdictional tax codes, strict GAAP reporting requirements, and deeply ingrained user psychology into functional, foolproof software.
The 2026 templates for osFinancials and TurboCASH prove exactly how deep this rabbit hole goes. We went from the tuxedo at a beach party realization that conversational buy commands build user trust to the massive 8-digit filing cabinet of the U.S. GAAP structure.
We looked at how a California LLC, using the word shares instead of units, is basically begging the Franchise Tax Board for an audit.
And we looked at the absolute chaos of U.S. tax stacking, where a business in Austin has to split a 7.75% tax 3 ways, and how the link tax automates that burden.
And we saw how that exact same link tax technology is deployed in Canada for a completely different legal reason, to ruthlessly separate recoverable federal VAT from non-recoverable sunk cost provincial retail tax.
And finally, the sheer complexity of automating the 50% meals rule and the absolute necessity of keeping the engine isolated from the vault in Quebec. So if you are running a business, looking at your own balance sheet, or processing a vendor payment right now, you should care about this. Because these invisible structures, the hard-coded rules we spent the last hour dissecting, are the only things standing between you and a devastating compliance failure. You don't have to be a multi-jurisdictional tax lawyer. You don't have to manually calculate 6-way fractional splits at midnight. The software has the law coded into its very DNA to protect you.
Which brings up a fascinating and somewhat provocative point about the future of this industry. We have spent this entire deep dive looking at how deeply rigid, hard-coded linguistic and jurisdictional rules are required to make accounting function today.
Right, we need 8-digit strict numbering schemas. We need strict sentence case visual hierarchies so human eyes don't get fatigued. We need rigid walls between vaults and engines.
But as artificial intelligence begins to ingest and generate financial ledgers dynamically in real time, will these rigid structures even survive?
That is a fascinating question. Because if an AI doesn't have eyes, it doesn't care if an account is an all TCAP yes or sentence case.
Exactly. If an AI can read a receipt, understand the context of a restaurant in Quebec, and instantly comprehend the intent behind the transaction, do we still need an 8-digit numeric code to tell the machine what an asset is?
Wow.
Or are we currently studying the final generation of human-readable charts of accounts?
Yeah.
Will the next step in software evolution be AI bypassing human syntax altogether, creating a personalized, fluid mathematical language of its own that operates entirely outside of English or French?
That is a wild thought to leave on. Are we looking at a perfectly localized, meticulously capitalized artifact of a dying era? Thank you so much for joining us on this deep dive. If your head is spinning and you want to actually see these charts, the 8-digit hierarchies, and the templates on screen, absolutely go check out those YouTube explainers, USA and Canada, the hidden rules of language and the hidden linguistics. They will show you exactly what we've been talking about. Until next time, keep your vaults and your engines completely isolated, and make sure you know if you are measuring with a meter or running a meter.